necesidad de seguir subiendo los tipos de interés. Saludamos en este entorno a Brian Vending, es President Managing Executive of MJP Wealth Advisors. Brian, thank you so much for having us a few minutes.
Thank you. Nice to speak with you again.
Brian, the most hawkish of the Fed is not afraid. We are talking about James Bullard. He doesn't see the recession. The president of the Federal Reserve of St. Louis said today that fears of a recession in the US are exaggerated. Should we believe him?
Well, I think that is the question that is prominently on investors' minds, because when you look right now where the market is trading based on valuations and looking back historically at other periods of time that the market has trended down in pricing in a recession, it's very close to the lows that we see right now. On average, going back to 1945, markets have gone down about 24% when pricing in that a recession is around the corner over the next 6 to 12 months. And I think right now, when you look at the economic data, a lot of information is actually skewed or influenced by the supply chain inefficiencies. And we do know that with the Fed making up for policy mistakes and lost time in fighting inflation, there's concerns about a recession happening over the balance of the year into next year were heightened when we saw some strong interest rate increases recently. And also the Federal Reserve talking about headline inflation, which is a little bit of a different policy decision than focusing on core. So we personally have a view that for 2022, we believe that it's not likely, at least as of right now, expecting a recession this year. But you should expect that as we move out into 2023, 2024, those probabilities go up because we are sitting in a slow growth economy, a slow growth world right now, and also the cost of borrowing as well as the impact of higher prices on consumers does impact growth. And we have seen a pause in activity as well in the housing market, but I don't think we're at a contraction right now with economic growth. I think it's just a comparison to an environment that was growing well above expectations last year to an environment this year that's growing significantly slower.
Brian, U.S. Consumer sentiment fell to record low in June, according to the University of Michigan. The final estimate of the Consumer Sentiment Index published by the university came in at 50 points in June, down from 58.4 points in May. How should we read this data?
Well, I think the data is accurate to what the consumer is dealing with right now. I mean, we have stark reminders of the cost of living every time we check out of a grocery store or fill up our cars or trucks at the gas station. So it's not surprising that consumers right now are feeling the pinch at the same point in time with headline inflation, being close to 9%, while wages are only up 5% on average year over year. There's obviously a gap there where consumers are feeling the hurt, as well as the fact that we know that rents have gone up as well to catch up with costs and maintaining properties. So I think the numbers are not surprising where we are. I think though where consumers will feel better moving forward is if we see headline inflation numbers come down over the next couple of months. We've seen core inflation come down since March, but we've seen headline inflation stay elevated really due to the impact of the war in the Ukraine and also rising food and energy prices. So I think moving forward, the consumers might be feeling a little bit better if we see those headline numbers come down, food and gas prices hopefully over time moderating, as well as some other costs moderating as spending is shifting from capital goods to services. So it's something we'll have to keep a watchful eye on. But again, not surprising that sentiment feels a little bit diminished as we move into the summer.
Looking at equity markets, what should we expect? The S&P index may fall another 24% through the end of the year. This is according to Societe Generale. What do you think about these expectations?
Sure. Well, I think if we're not moving into a recession this year, as we just talked about earlier, then it's possible that the market has priced in a lot of the bad news so far, and actually there might be an opportunity for a lift in the markets over the balance of the year. And I don't expect us getting to all-time highs again, but I think there is a probability and a setup that if headline inflation comes down, the Federal Reserve changes its tone as it's talking about interest rates and inflation, and maybe focus a little bit more on the money supply, which has really been the driver, in our opinion, of inflation since the start. That might calm investors, as well as we need to hear from analysts and publicly traded companies that earnings are still stable. I think on the flip side of that argument is inflation does not come down. The Fed has to continue to use a blunt tool of increasing interest rates while monetary quantitative tightening is taking place, with liquidity leaving the marketplace and the money supply shrinking slowly over time. And we'll get an update on money supply outlooks actually next week. And if that's the case, then earnings revisions will occur, and there's definitely a risk of markets potentially going down more in the short term of the balance of the year. But eventually, we'll get to a point of capitulation where the bad news has been priced in, and I think investors will look ahead. So we're really at a very critical point, I would say, going into the second half of the year. But as I said before, right now we're in the camp of being a little bit more optimistic and focusing on corporate earnings coming up, and obviously these inflation numbers and money supply outlooks from the Fed, as well as from other parts of the economy.
Thank you so much, as always. It's been a pleasure, Brian Vending.
Thank you.
Nos quedamos con ese análisis.